We just told you Amazon shares under a little bit of pressure this morning, but pairing losses from last night. The company provided disappointing guidance, cloud revenue missed estimates, big investments in AI. Joining us now with more on Amazon. In the overall market and economy, I want to talk about that. Stephanie Link, Hightower, Chief Investment Officer. I think we spoke to you maybe before Amazon, and I think either way you would buy the dip in Amazon. We'll talk about Amazon in a second, but you point out about the economy, and you had to actually take a double take at what GDP might be running. It's some ISM numbers. Suddenly, manufacturing is how we got a jobs report today. So things are too hot or just right, or is it good?
Things are really good, and it's really good to see you, Joe. Welcome back.
Oh, thanks.
The economy, look, the Atlanta Fed tracker, which we know is very volatile, it came in at 3.9% this week. And so maybe it's more like 3, maybe it's 2.5, whatever it is. The economy is doing quite well, and it's led by the consumer. If you look at personal spending and income, even savings. And then, yeah, you mentioned the ISMs. ISM Services has been in expansion for over 2 years, so that's no surprise. That continues, but it's the manufacturing piece that's now also doing better. If we got an expansion read this week, which was the first time in 26 months. And I think that ties back to what you and I have been talking about for a couple of years now, which is onshoring, reshoring, data center build out, grid repair. I mean, I also think it might have something to do with Boeing and them getting their act together as well. As we know that they were able to produce more planes, 737 MAX planes in January than people expected. And that's going to increase throughout this year. So really good things across the board. And we care because that impacts earnings. Earnings are running about up 12%, which is really nice, too. And what I'm encouraged about, and I know a lot of people are starting to talk about it, is so far we are seeing a broadening out. We have financials, healthcare, materials, all up more than technology year to date. And so that's encouraging as well.
What you mentioned about Boeing, that's a lot of stars aligning there, Steph. So 33 of the MAX in January, and you think you can get up to 38 eventually. Yeah. So you're buying that stock still pretty cheap on a historic basis. So 184. As a result, Boeing is your favorite stock at the beginning of the year?
Yeah, it is. It's a turnaround story for sure, with a new CEO who has a really good, proven track record, and them just, getting their act together and not having as much in terms of supply constraints. And that's actually what they talked about on their conference call. They can get to 38 planes per month because they can get the pieces for the planes. And that has been a big problem over the last couple of years as well. By the way, GE said the same thing about supply constraints getting better. So, and they're the engine maker. So, I like both those stories.
And you like Amazon still. This is if you talk about Amazon, you could talk cloud, you could talk, they're going to spend a lot of money on AI. They want to be a major player on AI. There's competition for what, one of their core businesses with Temu and Shein. And then there's the whole tariff issue. You would think that would help Amazon, but they're not immune to it either. But with all those things taken together, if it's down $7, you would buy it and you own it.
I was hoping it was going to be down more, to be honest with you, Joe, so I could get it even cheaper. But it's not down because more than 2.5%, 3%, because the quarter itself was very good. I mean, they beat on earnings. Operating income was really very encouraging. And retail margins at 8% were the best since 2004. And the growth rate was 10%, and expectations were for 9%. So they're doing really well in the U.S. International margins grew on the retail side 400 basis points. And, of course, AWS, which everyone's focused on, rightfully so, it still put up a 19% growth. I know whispers were like about 20, but 19% growth is steady, and that compares to declines seen from their peers. So, and they talked about capacity constraints. Actually, so did Alphabet. So it would have grown more without those issues. And I just think that there's so many tailwinds for the next several years in terms of AWS. And I think they're the CapEx at $100 billion. OK, so maybe that lowers your free cash flow to $55 billion for the year, but that's still really quite impressive.
I mean, that was going to be my question, Steph. The CapEx really stepping up more than 100 billion after, what was it, 75 billion last year. And that idea, are investors saying, yeah, we're still behind that. We're okay with going after it and spending as much as you can to capture this demand. We're not worried about anything we've heard from DeepSeek along the rest. This is money that you and other investors want spent.
Absolutely. This is going to be more than $1 trillion total addressable market between now and 2030. And, you know, IBM had an analyst day this week, and they said that 98% of enterprises are working on AI, but only 26% of those companies have processes in place to actually do something. So think about that tailwind for a minute. And they also believe that the CapEx spend of something like 300 billion this year will go to 850 billion by 2028. So a lot of companies are behind this. I'm behind this. A lot of us are, and I think we're in early innings.
Yeah, and we're in that weird. I don't even know what you call the first 100 days. It's the old administration. It's the new administration. And whose jobs number is this? This is the Biden administration's jobs number, but there are animal spirits with the Trump administration. It's, I don't know. We just got to go with it and not try and figure out exactly.
Well, there's all kinds of weird things.
Who's to blame or who's to credit?
Weird divisions that are going to be in this.
Yeah, it's going to be messy.
It's going to be a mess. I don't know, because this is always the month when the Labor Department goes back and revises everything. They take that jobs number and they add in everything they've seen from the county numbers that are a little more accurate and try and revise everything going back to March of last year. And then the Census Bureau in December really threw things off with what you can expect from the unemployment rate when they sharply revised the number of working people in this country based on immigration that started in full force back in 2021. So a lot of moving pieces that you're going to see in this.
Is there anything that could hurt the market or help the market with the jobs number? Could it be too hot? Are we still counting on rate cuts?
Yeah, well, average hourly earnings is something that we always look at. So that's going to be something that's top of mind. But honestly, you know, the non-farm payroll jobs, it's backward looking, Joe. You know that. Yeah, it's initial claims that's more forward looking. And initial claims are just fine, right? We're running at about 225,000 jobs, initial claims in the last 4 weeks on an average basis. We're nowhere near a recession, as we talked about with the GDP at 3.9. Recession for initial claims is something like 350 to 375,000. So we're nowhere near that. And I think we're going to see a solid number today. And should the market sell off, I think we're getting earnings, and that's what we watch to figure out where we want to buy. And I think you do want to buy if you see a pullback.